Today is Monday, September 21st, 2020. U.S. household income expectations, based from the University of Michigan, they, in just 1 year, based off the expectations, is below 85 for the first time since 2017. So income expectations per household, per capita, 1 year from now is below 85 for the first time since 2017, which obviously means that, in Layton terms, means that uh, income producing households, income generating households have lost faith, literally, in generating more dollars, or rather, of use value dollars, because what's happening right now, if you take a look at, for example, the M2 money stock, which is essentially the combination of M1 money supply, as well as money market security funds and conservative investments in fixed income and other debt, as well as savings and just cash that is held. So this is what's happening. I mean, the Fed is literally taking dollars out of the market. They're literally holding these dollars. They've bought over $1 trillion of mortgage-backed securities, and just 1% of them are commercial. Just 1% of the $1 trillion worth of mortgage-backed securities the Fed bought is commercial, just 1%. Also the fact that U.S. household credit availability, it's declined to its worst levels since, 2013, 2014 era. Clearly people are, as obviously stimulus has expired, right? It expired over the end of summer, end of August, and we're still in the huge level of uncertainty as to whether Democrats will enable a $1 trillion fiscal plan, because Republicans think anywhere over $1 trillion stimulus plan is too large. So there still needs to be an agreement there. Pelosi obviously stands by. She abides very strongly to her socialistic beliefs. The fact that the money printer, and she is right about this. It hurts to say she's right about anything, but she is right about this. The fact that the Fed might as well print the entire U.S. national debt, which is just over 26.7, almost $26.8 trillion. They might as well just print it all right now. I mean, what's the difference? If they can't produce inflation when, the M2 money stock increased, if you take a look going at the start of the pandemic crisis, increased $4 trillion in just shy of 7 months. Obviously, from the gradual accumulation of debt monetization since the end of the gold standard in 71, we've obviously since then been seeing a massive compound accumulation of dollars, which is devaluing the dollar. It's devaluing the currency. And if we take a look at DXY, for example, which is the dollar index, which is actually pretty much the only thing that's higher today, which is why precious metals are down, because the dollar is higher. But anyway, that's not what I wanted to go to. A 52-week chart for you. If we actually, let's go to a 20-year. I already drew this trend line, but if we take a look, it's, on a technical analysis standpoint, the dollar index, by the way, is primarily made up of the euro, right? Which is, it's been trending at that 120 resistance for such a long time. It's been making a strong case for that 120 against the US dollar and that, euro USD pair. But the euro has been strong, long and strong relative to the US dollar, which has been weakening. Obviously, these three candles pretty much represent the entirety of 4 or 5 candle represent the entirety of the pandemic. So, what really needs to break is that 88 crucial support line, which also happens to be this very long-term chart, 200 EMA, which is the white dotted line. And this purple ascending support, right? 1 higher low, 2 higher lows, and 3 higher lows. But look what's happening here. Look what's happening at the bottom of this low. If we narrow down, you see the difference between here and here and here and here, all, let's visualize this better for you. This is the same kind of consolidation pattern off the lows as that, and the same as that, because it's bouncing off ascending support, and it's continuing with confirmation of higher lows, 3 higher lows. This is the 4th higher low, but the problem is if we zoom into the 52-week to get a better idea of what we're dealing with, here's a channel. This is a very bearish case for the US dollar. The fact that it's forming this bear flag, right? From here, that's your resistance, that's your support. It's trading at this channel, and it's just a matter of time before it breaks even lower and ultimately crashes and loses its entire currency, world reserve currency status. But that's my opinion. Anything can happen really. But I mean, again, going back to the fact that the Fed can support, such humongous debt monetization levels when, things like inflation have been under 2% for the better part of 20 years, it doesn't really make any sense, and it's not supposed to, because price discovery is ultimately manipulated because of monetary and fiscal policies. The disruptions that they have created throughout financial markets, and especially the overall economy, is disastrous. And it's only, the bubble is only deflating now. When the bubble actually pops, that's when we see the crash of the US dollar. That's when we see hyperinflation potentially kick in. But anyways, yeah. And also another thing to note is actually a few things. Well, number one, we know that, let's pull up the NASDAQ here for a second, I believe. Right, this is the NASDAQ index. And, basically, until recently, systemic risk pretty much continues to foreshadow with the largest net short position in NASDAQ 100 contracts. I believe in just over a decade, like 12 years, that's the case. So it's the largest net short position in NASDAQ 100 futures. If we go to S&P 500 E-mini futures, I'm just curious, of course it's down 3% contracts. The contracts are down 3%, because this is the biggest net short position, at least in the NASDAQ 100 futures contracts we've seen. Of course, that's systematically affected across all major indexes, right? Because they're all, because mega cap tech stocks are pretty much the majority weight of these indexes. Meantime, the VIX, the fear index, the volatility index, finally over 30 because of today's global stock market sell-offs. 30-year treasuries declined the most today in like over 2 months. And that goes for the German Bund yield too, which is down like almost 1%, almost 0.75%, like just over 0.5%. So it's literally down to negative 0.51%, pretty much. I haven't checked since yesterday. But also the fact that the Fed has bought, trillions and trillions of dollars in MBSs, and never mind treasuries, which is the most saturated streamline that the Fed initiates buying opportunities and quote unquote opportunities, which they're earning 0% on, and they're rolling over into the long end of the curve, like 30 years, which is why, as short-term notes, for example, are becoming negative on a real rate, 30 years, if you take a 30-year mortgage, it's at just shy of 2.5%. I mean, the last time you've seen that has been quite some time, over a decade. And I think that it's just only going to implode from there. And meantime, and this again is systematically, rather idiosyncratically affected in states, because states are in major trouble with their unfunded pension liabilities. Because states can't print money. The Fed can print money, but well, technically the commercial banks can print money, but the states cannot. They can't print money. So what do? They hold on to treasuries as though it's its own, as though treasuries are its own version of money itself. But they make the mistake because, for example, California, they will not be accepting new unemployment claims for the next 2 weeks, because of these humongous backlogs. They're not going to be, and pretty much quite a few more states are going to be announcing just the same thing, because the amount of people that have become permanently lost jobs is only increasing, because it's kind of as though you're looking at a bag holding position in a stock when it goes all the way to $50 and you're still holding it 3 months later and it's down at $10. You're considered a bag holder, obviously. So it's that's the same relation there. Obviously panic selling has occurred since last week, and we're not really seeing much of to say the least, confidence in any aspect of the overall economy. But something I did want to do was I wanted to share my screen here, which is the U.S. national debt clock. And the U.S. national debt clock essentially gives us all the information we need. Right off the bat, spending to GDP ratio is at 50%. Total debt to GDP is over 150%. If any of you are a fan of Warren Buffett, you know that his favorite economic indicator is the market cap to GDP ratio. If total debt to GDP ratio is 154%, which is pretty much World War II levels, World War II peaks, never mind. The market cap to GDP ratio is somewhere around the same area, like 130, 135%. Given the euphoria financial markets have been trading in recently, now we're taking some steam off the uptrend, which technically, yeah, that's considered a healthy part of an uptrend. But when it's manipulated by one buyer, aka the Fed, things can be distorted in the wrong inverse kind of manner, which causes price manipulations and price action of securities. Today was a good example because we had Nikola shares tumbling 25%. If you thought I retweeted a tweet today saying that, I forget who it was by, it said, if you liked Nikola shares in June at 90, you'll sure as hell like them today at 20. And it kind of chuckled at it at first. It was kind of funny, but it's true. There's so many cases of this as well throughout the pandemic because, the amount of zombie companies in the United States is also approaching World War II peaks. So essentially what zombie companies are, it's pretty simple. It's where companies that have massive amounts of debt, and just like our economy, a debt-based economy, it needs more debt to run. So they're running massive leverage ROEs, they're running massive leverage balance sheets, and they have no way of paying it back. But it's okay for now because the federal government is on a deferral basis in terms of tax revenue write-offs and whatnot, and payroll and etc. But the point is, as businesses that are not healthy take advantage of these guaranteed loans and subsidized opportunities from the Fed, and again, I emphasize the quote unquote opportunities the Fed provides, because they're not opportunities. We have, to put it this way, accordingly to the U.S. debt clock, we have almost $27 trillion in U.S. national debt relative, to it's roughly $10,000 profit per person based off overall U.S. federal tax revenue. But look at the actual budget deficit. So if we're in over $3 trillion, we're trading over $3 trillion budget deficit with $10,000 per person. I mean, you could just do the math in your head and you automatically see a surplus of how many dollars we owe relative to how much each citizen has kept. I mean, yeah, we've been seeing recently that dollars have been kept. Savings per family, $26,000 versus actual debt is 62,000. So it's very clear that the country is spending more than it's saving and investing, and that is not a productive economy. It's not productive one bit. If we actually value if we actually value commodities relative to equity prices, commodities are the cheapest it's ever been. Literally, precious metals, copper, corn, anything. So it's pretty staggering to look at these numbers. Look how much we spend, over $7 trillion, while we have a GDP of just shy of $20 trillion, which half of it is probably sovereign debt, which is why we're going to have a sovereign debt crisis, because we have no cushion. We have no cushion as a country. Look, these are minuscule revenue items. I mean, relative to the overall balance sheet. If we take a look at this chart, right, this is a very closely correlated chart between, a break-even 10-year inflation rate alongside with the S&P 500, and the S&P is in the white, and 10-year break-even inflation rate is the yellow. And the reason why we see this is, number one, because the United States is not an emerging market, but a developed market, right? The United States is a developed market. And so what we need to understand is there's going to be a close correlation to the Fed's inflation rate, which they typically measure with CPI. Right? PCE can be exaggerated in some areas of the economic cycle. But anyways, right, we see that as stocks go down, as stocks go down, as they consolidate, even right here, right, we saw that, inflation was correlated very closely with it, right, because that shouldn't really be happening. It kind of should be the opposite, because so long as the Fed adds to the M3 money supply, as so long as they add to their balance sheet and their reserves are at maximum capacity, but there really is no maximum capacity, right? They can print as much as they want. But there does come a threshold point where if they print at a certain point, so much, then, that's what inflation is. It's Milton Friedman's actual definition of inflation was, or rising inflation rather, reflation, which is to, more dollars paying for less goods. And, more dollars that are in the money supply obviously creates, higher inflation. It may be deflationary at first, like we saw right here back in February, back in March. Initially the Fed dropped their effective federal funds rate basically to zero. And even before that, we performed QE 3 times in 2019, the last quarter of 2019. So we've already been expecting something like this. This really shouldn't be anything new. But hence, inflation is so closely correlated. Even at this rebound from March lows, inflation followed with it. So it's kind of interesting because it's entirely controlled by the Fed. This correlation is entirely controlled by the Fed. If the free market controlled this, inflation would be through the roof right now in both consumer and asset prices, right? Because inflation has been taking place in asset prices because that's what the Fed is buying. They're buying the treasury market. They're even buying corporate debt and even derivatives. So that is why. If we go to an emerging market like Turkey, right? If we go to their, if we take the same kind of, 10-year break-even inflation rate relative to Turkey's price to book, forecast for stock valuations, we'll see that it's exactly inverse. It's a strong negative correlation to the 10-year break-even rate of inflation, right? So when forecasts go down, inflation goes higher. That is what an emerging market should look like. An inverse relationship, a strong negative correlation between performance of publicly traded items versus the actual money supply, which is the result, the actual rising of prices, which is the result of the expanded money and credit supply. So hence the free market is working, but Turkey is kind of a different situation because they're facing right now an extremely sensitive situation with their currency relative to the US dollar. It's completely devalued. They're facing many border issues and a lot of economic front issues, etc. But the point is, these correlations matter in economic cycles because inflation is not supposed to be fixed by the Fed. It's supposed to be measured based off the supply and demand of global trade and domestic trade, of course. But anyways, of course, what we're seeing right now is, I'm going to sum it up with this, is, of course, former Fed Chairman Alan Greenspan's, he was back in, he transitioned in the Fed from, the 20th century to the new millennium as the Fed chair, and he was through it as the Fed chair in the dot-com, and he was the first to say in '99, right? Irrational exuberance. He gave it in his speech in during the dot-com era. He gave a speech about irrational exuberance. And what that is what we're seeing right now, but on a much larger scale, pretty much, almost the same. Where people are buying false valuations, they're bidding up prices and bidding them up even higher, and then bidding them up even higher. And the problem, though, is, the focus has been on the FANG stocks. The focus has been on the mega cap tech stocks, all of which have been gaining major saturation. For example, when Tesla's trading just 3-4 times sales, but their market capitalization is, up 10-20 fold, it doesn't really make any sense. It doesn't make any sense at all. People are buying on pure speculation. So irrational exuberance, I think, is certainly appropriate to include in this crisis, to say the very least. But anyways, this is all I had to say for today, ladies and gentlemen. I hope you enjoyed what I had to say, and please just don't forget, we are not financial advisors. We are not money managers. Anything we say is purely and only for educational purposes only. So please do us a favor and help us all out here. Like the video, hit the subscribe button, and of course, we'll see you very, very soon. Finance nerds would like to very much for your time. We'll see you soon.